How do credit cards work? Most Americans don't understand fully. We know that we go to the store, we shop online, we swipe, we enter in a card number, but we don't understand the complex ecosystem that is making all of these processes actually function. We don't understand the complex regulatory structures. We don't understand the business ecosystem. But today, the Taxpayers Protection Alliance has invited Tom Rosenketter to explain some of these things to us and to talk about the ways that the Credit Card Competition Act and other similar regulatory proposals that essentially amount to rate regulation would affect the financial industry, small institutions, and average American consumers. Tom, thank you so much for joining us.
Thank you, David. Glad to be here and appreciate the opportunity to talk about cards with you and your audience.
So my first question for you is essentially from the perspective of day-to-day operations, how would proposals like the CCCA affect financial institutions?
Well, thank you for the question. Maybe I'll just start with a little bit of background just to talk about the importance of this product. And I would note that last year there were 154 billion credit and debit card transactions in the country through more than 2 billion debit and credit cards. That amounts to about $11 trillion worth of transactions processed. And I would also note that these are products that are well used by almost all Americans. Based on survey result we've seen, it appears that over 90% of US adults have a debit card, and over 80% of US adults have had a credit card in the past year. So in other words, the important point here is this is a product that Americans like. They have lots of choices in the market. They can use cash, ACH, peer-to-peer networks like Zelle. There's crypto, many other payment mechanisms in there. But so this is a competitive market, but Americans really like their cards and merchants like them too.
I think you raise a really good point, which is that a lot of folks advocating the kinds of proposals we're talking about say that there's no competition in the market. They say that it's stagnant. There's a few players who are dominating everything, and that's simply not true. And the market actually has a very intricate balance between large institutions, small institutions. And one thing I'm really curious about is looking past the biggest players that everyone talks about constantly. How exactly would these proposals affect smaller financial institutions?
Yeah, it's a great question. And I would say that the best example of this is to look at the Durbin Amendment, which passed as part of the Dodd-Frank Act and put in place restrictions or price controls on debit interchange. And I think what we will note is that the policy impact that came out of the Durbin Amendment is inconsistent with stated US government policy and stated policy of the regulators. You know, for example, Michael Barr, Vice Chair for Supervision of the Fed, has said that he wants capital rules to support a vibrant, diverse banking system with banks of all sizes. The OCC, in its 2023 annual report, noted that it's committed to promoting a vibrant and diverse banking system. But what we've seen happen in the Durbin Amendment is it's inconsistent with the overall policy of the government, but it's also inconsistent with the aims of some of the statutory language. So the statutory language requires interchange fees to be reasonable and proportional to a covered issuer's costs, not merely equal to, and certainly not less than those costs. But what we've seen in many different instances, for example, a Mercatus Center study found that the Fed's price cap reduced earnings at nearly 3/4 of all community banks and credit unions. Additionally, we've seen through other data that the current interchange cap on debit cards has prevented more than 24% of non-exempt banks from recovering their costs. And there's currently a Reg II proposal that's in front of the Fed right now. If that rule were to go forward, it would deny cost recovery to more than 1/3 of debit card issuers. So what we've seen is there is an impact on small financial institutions, and that impact is so great that those institutions basically have to offer some of these products as a loss leader to their customers.
So I think you bring up a really interesting point, which is that all sorts of promises were made about the Durbin Amendment. Many of the same promises are being made about the CCCA. They say that the benefits of these proposals are going to accrue to all sorts of people, and the negative impacts are essentially going to go to, again, the purported monopolists who aren't actually monopolists. But as you also pointed out, that isn't what's actually happened. We've had many unforeseen consequences, and we've seen the benefits generally go to large retailers. These sorts of things are not getting passed on to consumers. So can you talk about what are the unintended consequences that have been negatively affecting consumers from all of this?
Yeah, so I really appreciate the question. Thank you, David, for asking. And I think this is really the crux of the issue, is that government policy should benefit the end consumers. They should do it by creating a competitive marketplace that offers all the various service providers to compete to the highest level to ensure customers get the best value for their money that they spend, whether it's on payments or any other product in the US. And what we've seen from the debit interchange law that was passed in the Durbin Amendment is that basically these price controls hit innocent bystanders, the American consumers. And the issue here is that the evidence is really clear when you look at the Reg II's impact in the Durbin Amendment. The availability of free checking was reduced. Minimum balance requirements were increased. Monthly fees became more common. And importantly, in the debit card space, reward programs ceased to exist. And so the issue is, when this law was passed, Mallory Duncan, a good friend of mine at the time from the National Retail Federation, was quoted as saying, "Merchants are ready to pass lower swipe fees on to consumers in the form of discounts." That's a quote. Since then, it's estimated that corporate megastores have pocketed over $100 billion. And unfortunately, there's little evidence to indicate that merchants have delivered on the promises offered by my friend Mallory Duncan. According to the Federal Reserve Bank of Richmond, 75% of merchants reported that they did not change prices, and 2% reported that and 23% reported that they actually increased prices. Only 2% reported that they decreased prices. So I think, getting back to the beginning of your question, we've already seen this movie. And making more change along these same lines is like the definition of insanity. It's doing the same thing over and over again and expecting a different result. And when we think about credit interchange, those impacts will be the same. It'll be the loss of credit card rewards, increases in interest and fees to consumers, and further ceding power to government regulatory agencies, not to consumers, who are best positioned to make these choices.
It is quite staggering that Senator Durbin a decade ago introduced a law that theoretically could have benefits and drawbacks, though I suspect we had good reason even back then to be suspect of it. But he gets this amendment enacted, and then, despite the decade of very consistent evidence showing that it has had negative effects for the economy generally and for consumers, he's essentially doing the exact same thing, but in a slightly different guise with the CCCA. And if that doesn't tell you something about how government works, I don't know what will. So my next question for you has to do with the number of proposals we've seen. We've seen proposals from Congress. We've seen proposals from various administrative agencies. This is a chaotic regulatory environment. We, in a weird way, have both Congress and administrative agencies acting as sort of de facto parallel legislatures to one another, and each advancing a different conception of how these services should be regulated. And I would assume that creates a lot of uncertainty, especially with the prospect that the administration may change, new leadership may ascend to these various agencies. Can you talk about how the regulatory uncertainty affects the financial services industry?
Yeah, happy to do that. But before I get to that specific point, I would just raise that the Reg II rulemaking that's occurring at the Fed, in some ways, is a good microcosm of how Americans feel about this. So this is sort of a real life situation where they've gone out to the public and they've opened up a comment period, which closed on May 12. And what we found, based on the comments released by the Fed so far, is that the comment file was unexpectedly negative. Of the 400 letters received by the Fed, 300 of them, or about 75%, opposed to rulemaking, And of those, about 170 of them discuss the negative impact of the proposed rule on consumers. So what's interesting is when this is really put up for public comment and debate, Americans like their cards, they use their cards, and they don't like the impact of these proposals, and they're speaking out to it in these comment periods. Um, so moving now to your question, yeah, it does create a lot of uncertainty in the marketplace. We're seeing it in some of the states where there's been attempts to try to regulate interchange. There's the Reg II rulemaking at the Fed, and then there's the congressional attempts that we've seen through the CCCA. But I will say that as we talk to people, whether they're policymakers or consumers, we feel like we have the American public on our side on this, even if we do have a noisy bunch of advocates on the other side.
Yeah, and just to go back to the proceeding that you mentioned at the Federal Reserve, which would further tighten price caps on debit cards. The really astounding thing that came out in one specific comment that I'm thinking of, and I know I've mentioned this before, but it was a comment letter from a small bank. And essentially the upshot was that by tightening these caps, the Federal Reserve would deprive the commenter of the necessary revenue to offer low cost or free financial services to the quote unquote most vulnerable in that community. So especially now with an administration that is so focused on ensuring access to all sorts of financial and other services to, again, the quote unquote most vulnerable in American society and the most disadvantaged economically, it's astoundingly contradictory to be pursuing these price cap proposals. So my final question for you has to do with innovation. And I'm going to go back to where we began the interview. Most Americans don't fully understand how financial services work. They don't understand how we got where we are, and they don't quite understand where we're going. So my question for you is, were all of these proposals or some of these proposals to be enacted, how is that going to change and hamper innovation for financial institutions, for credit card companies, for the larger ecosystem, and how will that in 10, 20, 30 years disadvantage the average American consumer?
So, Dave, thanks for that question. I would say that, in general, we see that once the government interferes in the market, it creates disincentives to innovate, period. And I think what we see is as price controls and regulations force banks to operate at a loss, any incentive to innovate disappears. And in fact, there's some incentive not even to be in that market at all, which reduces competition and availability of products and services from a number of different participants, which is at odds with having a fully functioning market. And I would say that, some in DC and even the states want to treat our payment systems like a public utility. And we know that that system doesn't always work super well. For decades, infrastructure investment in California has suffered, and we've seen the results of that in California with wildfires and other things. And so we know that underinvestment leads to a less good product and service for customers, and in some cases, one that's unsafe, as we saw in California, and we could see in the payments system as well, if we can't continue to invest in things like fraud security, cyber, and so forth. And so the other question I would say is, so what incentives are there for financial institutions to invest in debit cards when they're taking a loss? Probably not that much. And we know that based on the Fed Reg II proposal, more than 1/3 of banks may be in that situation, and credit unions, if that rule were to be enacted as promulgated. And then the other issue is, once you take all of the profit incentives out of the financial systems, it's a road to mediocrity. And I think that's a negative thing for the US, for American consumers, but also for the US, where our payment system is really the envy of the entire world. It's something where we have a competitive advantage and something we need to continue to protect.
I love that answer. We may not know precisely where we are going, but we know that if we hyper-regulate and slap controls on prices, we will definitely not get there or at least hamstring ourselves along the way. Tom, thank you so much for doing this. This has been an absolute pleasure. And I thank you just again for coming on.
Yeah, thank you for having me. Happy to come back anytime.